Welcome back to Pamuka Wealth Empire, your go-to channel for all things finance. In today's video, we'll break down some essential financial concepts and terms that you need to know to take control of your financial future. So grab a notebook and let's dive in. First up, let's talk about budgeting. Budgeting is a fundamental aspect of managing your finances effectively. It's not just about keeping track of your expenses, but also about planning for the future and ensuring that you can meet your financial goals. Budgeting is the process of creating a plan to spend your money. This plan, often referred to as a budget, helps you allocate your income towards various expenses, savings, and investments. By doing so, you can ensure that you are living within your means and are prepared for any unexpected financial challenges. This spending plan is called a budget. A well-crafted budget takes into account all sources of income, such as your salary, bonuses, and any other earnings. It also lists all your expenses, including fixed costs like rent or mortgage payments, utilities, and variable costs like groceries, entertainment, and dining out. Creating this plan helps you determine in advance whether you will have enough money to do the things you need to do or would like to do. It allows you to prioritize your spending, ensuring that essential expenses are covered first, and then allocating funds for discretionary spending and savings. Budgeting is simply balancing your expenses with your income. It's about making sure that you don't spend more than you earn. This balance is crucial for maintaining financial stability and avoiding debt. If they don't balance and you spend more than you make, you will have a problem. Overspending can lead to accumulating debt, which can be difficult to manage and can have long-term consequences on your financial health. Many people don't realize that they spend more than they earn and slowly sink deeper into debt every year. This can create a cycle of financial stress and anxiety, making it harder to achieve financial goals and secure a stable future. By creating and sticking to a budget, you can avoid these pitfalls and take control of your financial situation. Budgeting also allows you to set aside money for savings and investments, helping you build wealth over time. Whether you are saving for a major purchase, like a home or a car, or planning for retirement, a budget can help you stay on track and reach your financial objectives. In summary, budgeting is an essential tool for managing your finances, ensuring that you live within your means and preparing for the future. It requires discipline and regular review, but the benefits of having a clear financial plan are well worth the effort. Next, let's delve deeper into the terms assets and liabilities. These concepts are fundamental to personal finance, and understanding them can significantly impact your financial health. An asset is anything you own that adds value to your life. This value can be tangible or intangible, but the key is that it contributes positively to your financial situation. Assets can take many forms. For instance, it could be money in your bank account, real estate properties, investments in stocks or bonds, or even valuable items like jewelry or art. Essentially, anything that can be converted into cash or has the potential to generate income is considered an asset. It's important to regularly evaluate your assets to understand their current value and potential for growth. This helps in making informed decisions about buying, selling, or holding onto these assets. Liabilities, on the other hand, are what you owe. These are your financial obligations that need to be paid off over time. Liabilities include debts such as loans, mortgages, credit card balances, and other forms of financial obligations. These are amounts that you are legally required to pay back, often with interest. Managing liabilities is crucial because they can quickly accumulate and become overwhelming if not handled properly. It's essential to keep track of all your debts and have a plan to pay them off systematically. One effective way to manage liabilities is by creating a budget. A budget helps you allocate your income towards paying off debts while also saving and investing for the future. The ultimate goal is to have more assets than liabilities. This balance will increase your net worth, which is a key indicator of your financial health. A higher net worth means you have more financial security and freedom to achieve your goals. By understanding and managing your assets and liabilities effectively, you can work towards financial stability and success. This knowledge empowers you to make better financial decisions and build a secure future for yourself and your loved ones. Now, let's discuss savings and investments. Savings refer to the money you set aside for future use. It's important to have an emergency fund that covers 3 to 6 months of your living expenses. Investments are assets or items acquired with the goal of generating income or appreciation. Examples include stocks, bonds, real estate, and mutual funds. Investing is essential for building wealth over time. Let's move on to credit scores. Your credit score is a numerical representation of your creditworthiness, ranging from 300 to 850. This score is calculated based on various factors, including your payment history, the amount of debt you owe, the length of your credit history, the types of credit you use, and any new credit inquiries. It impacts your ability to borrow money, as lenders use this score to determine the risk of lending to you. A higher credit score indicates that you are a lower risk, which can make it easier to get approved for loans and credit cards. The interest rates you'll receive on loans and credit cards are also influenced by your credit score. A higher score can qualify you for lower interest rates, which can save you a significant amount of money over time. Your credit score can even affect your ability to rent an apartment or get a job. Many landlords and employers check credit scores as part of their application process to assess your financial responsibility. To maintain a good credit score, it's important to manage your finances responsibly. This includes paying your bills on time, as payment history is one of the most significant factors in your credit score. Keeping your credit card balances low is also crucial. High balances can negatively impact your credit utilization ratio, which is the amount of credit you're using compared to your total available credit. Avoid opening too many new accounts in a short period, as each new account results in a hard inquiry on your credit report, which can temporarily lower your score. Additionally, having a mix of different types of credit, such as credit cards, mortgages, and auto loans, can positively impact your score. However, it's important to only take on credit that you can manage responsibly. Regularly reviewing your credit report is also a good practice. This allows you to check for any errors or fraudulent activity that could negatively impact your score. You can request a free credit report from each of the 3 major credit bureaus once a year. If you find any inaccuracies, be sure to dispute them promptly to have them corrected. This can help ensure that your credit score accurately reflects your financial behavior. Setting up automatic payments for your bills can help you avoid late payments, which can have a significant negative impact on your credit score. If you're struggling to manage your credit, consider seeking advice from a financial advisor. They can provide personalized guidance to help you improve your credit score and overall financial health. Remember, maintaining a good credit score is an ongoing process, but the benefits of having a high score can make it well worth the effort. From lower interest rates to better job opportunities, a good credit score can open many doors. Lastly, let's talk about compound interest. Compound interest is the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods. This can significantly grow your savings and investments over time. The key is to start early and be consistent. Understanding these financial concepts is crucial for making informed decisions and achieving financial stability. If you found this video helpful, please give it a thumbs up. Subscribe to Pamuka Wealth Empire and hit the bell icon to get notified of our latest videos. Share your thoughts and questions in the comments below. Thanks for watching, and until next time, take control of your wealth.